Hello, I'm Kevin Thiele of Future Ready Group, and I'm talking to Peter Towers, Managing Director of ESS BIZTOOls, a professional business accountant for many years, including CFO, Company Secretary of a listed public company, partner in an accountancy firm, business advisor for an Australian government grant program, and business consultant. ESS BIZTOOls is a resource centre for business and their advisors, with highly useful topics such as cash flow management, debtors management, business strategies, buying and selling a business, succession planning, etc., delivered by video, webinar or text, and all written by experienced hands-on business professionals, not academics. Today we are talking about crowdsourced equity funding, a government-backed method for raising finance for SMEs outside of the banking system, and which is already used extensively in other countries like the US, UK, Canada and New Zealand. It is different from crowdfunding, which is social media based. Over to Peter to explain.
Good morning, Kevin. How are you?
Good, Peter.
Yes, well, crowdfunding has traditionally been the operation whereby people who are trying to raise money for a accident victim, a funeral, or some other personal event go to the wider community to try to raise money. There's no law pertaining to that, but that's how the system works, and there are companies out there which will assist people to do that. Crowdsourced funding equity raising is actually buying shares in a private company. The investor is allocated shares in that company, and they then become a shareholder in that company on the ongoing basis.
What limits are there and how much can I raise each year and for how many years?
The capital that can be raised is up to $5 million in a 12-month period for the company. So that's the maximum. But companies can raise smaller amounts that aggregate to that sum.
Okay. What are the eligibility requirements?
Basically, a company has to be in the group of having a turnover of under $25 million and having gross assets valued at less than $25 million, not listed on a stock exchange. They're the basic rules that apply.
Given that it's presently difficult to obtain financing from banks, what security must be given to potential investors, if any?
There's no security given. What the investor is obtaining is shares in a private company that's going to operate as if it was a public company. The due diligence processes that are built into crowdsourced funding equity raising by the government mean that for a company to be accepted by a crowdsourced funding intermediary, which is a specialist company that's been appointed by the Australian Security Investment Commission to act as the monitor, the gatekeeper on this legislation, hopefully will have unearthed anyone that does not have a legitimate company and a legitimate business to operate. But there is no security as such. The company doesn't have to pledge any of its assets as part of this capital raising process.
When they become shareholders, do they have voting rights attached to their shares, which would dilute your control or the director's control of their company? Or do they just simply get paid a dividend?
No, they are shareholders, therefore they have a vote. And this is all part of wealth creation from a company's point of view or the original shareholder's point of view. The investor is probably going to have a very small shareholding and therefore a fairly small vote in the overall company. But what I would be doing, and anyone else using the ESS BIZTOOls crowdsourced funding equity raising product package would be doing, is first of all valuing the company in its current state so that shares are allocated to the original shareholders equivalent to the value that the company has at day one. Obviously, when a sum of money comes in, whether it's $500,000 or $5 million, shares have got to be allocated, and that is going to change the percentage within the company. Therefore, if the company was only worth $1 million at the beginning and then was able to attract $5 million, it stands to reason that the original shareholders are going to have their share percentage significantly diluted if that was the scenario. But if the valuation was $2 million to start with and you raise $500,000, you're not going to have that extreme extent of dilution occurring.
Okay. How does a company start the whole crowdsourced funding process?
Good question. I think they approach someone like you or me or one of our subscribing accounting firms all over Australia and have a conversation. The process that I suggest that accountants utilise is that they first of all review their list of clients to determine who might be a company that had some interest in crowdsourced funding equity raising. And we have a form to assist in this identification of who of your clients might be interested. Obviously, there's the legal tests that they have to comply with, the turnover, the asset value, not on a stock exchange. But then there's other tests. The company's going to need a vision. It's going to need to have a management team that's got a fire burning in their bellies. They're wanting to grow their business. They might be wanting to undertake scaling up. Their turnover currently might be $1.5 million, but they would like to get to a $5 million in the next 3 to 4 years. What they are going to need is cash. You just can't grow companies without money. So I think it's up to the accountants to be doing some homework on their clients and saying who might be interested in this process, and then inviting them in for a seminar or one-on-one meeting or a webinar to find out which clients are interested. For the small, medium business operators who are watching this conversation, I suggest that your approach is that you approach you, Kevin, because this is going to be shown on your website, that they approach you for a discussion, and you will then be able to guide them or refer to them to some accountants that are subscribers to ESS BIZTOOLS that will be able to help them. But we're able to help businesses, no matter where they're situated in Australia, to get involved in this process.
Does the accountant have an ongoing role? Like, I imagine that the business process would require a business plan, which included cash flow projections, valuations, etc., etc.
Yeah, there's an opportunity for an ongoing role. Let's go back to what you finished in your question with. The business plan, budgets, cash flow forecast, business valuation is all necessary part of the preparation of the crowdsourced funding offer document, which is needed to be prepared to be uploaded to the intermediary's website so that the company is able to raise its capital in the first place. The significant opportunity for accountancy firms is that at the end of this process, the intermediary has no further involvement with the company, but there is a real opportunity for the accountancy firm to put their name forward as being able to perform a virtual chief financial officer service for that company. Because the company's raised some capital, it's probably not enough money, or they mightn't have enough work for a full-time CFO, but they will have an understanding of their directors' responsibilities to ensure that prompt, accurate financial accounts are being prepared every month, so that the board of directors is very much aware of the trading performance that's occurring within the company, because obviously the directors have got pretty horrendous legal responsibilities in operating a company, especially a company that is now a de facto public company. And they're going to need strong accounting support to be able to ensure that the directors are able to adequately perform their duties and responsibilities under the Corporations Act.
What happens if funding fails to achieve the level sought, and how much out of pocket would the company be?
Well, to answer the first part of the question, in the unfortunate position that the minimum subscription is not raised, the intermediary is required by the law to refund all monies paid, 100% of it, to the intending investor. The company's got a maximum of 90 days to have their company listed on the intermediary's website to be able to raise the company, or whatever lesser period the directors have chosen. I always suggest go for the 90 days, give yourself the maximum opportunity. The cost of the company, yes, the company has borne the costs of the business plan if they didn't have one before, the budgets, the cash flow forecast, the understanding of what the intermediary's role is, which is very important for directors and managers, and the cost of the crowdsourced funding offer document. So if there's any doubt, I'd be erring on caution. Maybe the company needs to spend a further 12 months getting themselves investment ready. And accountants should be thinking very seriously of this when they're advising their clients. This is a complete picture that we're having to present to be able to raise capital. Remember, we're going to the public, people who basically do not know the company, the managers or the directors, to be able to raise capital. Therefore, it will enhance the company's ability to raise capital if they've had some media exposure. There's been some good stories written about them. They've got a social media presence, and there's no doubt that they need some fans. Now, preferably those fans should be current customers, suppliers, employees, friends of the family. But not every company that raises crowdsourced funding, equity raising, will already be operational. Some will be basic startups, but they have a group of people who are aware of what they're trying to do, aware of the directors and senior managers who will support them.
If my initial application for funding fails, can I try again, or is there a time restriction or what?
No, you can try. You can start the process all over again sometime later. Whether you want to use the same intermediary, you may have blamed that intermediary as to the failure. But I think directors would need to have a good, close look at their own situation before they went through what could be a very costly exercise if it failed again. They will need to declare that when they meet with another intermediary that they've already had one attempt. And there would need to be an appropriate due diligence review on what went wrong on that first attempt at raising capital. There are companies out there who are raising capital. There have been some, of course, who have failed, and that will always be the case. But companies should not be blindly going back and trying to have another attempt without having had a due diligence review, preferably conducted by an individual who was not associated with the original attempt, to try to determine what improvements could be made in presenting the company's story.
What type of investors could I expect to invest in my company? Given that there's an upper limit of how much they can invest, would that attract professional investors, or basically it's a mums and dads type scenario?
This legislation was put in place by the government to try to enable mum and dad investors, what the legislation calls retail investors, to be able to invest in some of the new types of companies that have emerged in Australia in the last 20 years, that in the main, retail investors have been unable to make investments in, because they were below the threshold for being considered to be a sophisticated investor and were not eligible to apply. But that doesn't mean that sophisticated investors are not investing in crowdsourced funding equity raising companies. In fact, some are. We have a recording of a situation for the Endeavour Brewing Company when I interviewed the CEO of that company in Sydney, and he indicated that one of the investors had contributed $100,000. I asked the question in the interview, does that mean that that investor was a sophisticated investor, because a retail investor could not have invested $100,000? And the CEO confirmed that that investor, in fact, was a sophisticated investor. The situation in Sheba Proprietary Limited, the Melbourne-based all-female rideshare company, which raised $3 million, apparently $1 million of that was invested by a female sophisticated investor. So some sophisticated investors are venturing into crowdsourced funding. There's no restriction on them. There's slightly different rules applicable to sophisticated investors. They don't have the benefit of the 5 business day cooling off period, for argument's sake. So once they sign and hand their money over to the intermediary, which is what they have to do if they're applying for shares, they are committed. Whereas a retail investor has a 5-day cooling off period that they can apply for their money to be returned to them, no questions asked. So there is an opportunity for both, but the government believes, and the evidence so far is on a numerical basis, most of the investors are coming from the so-called retail investor market, the mum and dad market.
Okay, well, Peter, I don't have any more questions. Is there anything else you'd like to add?
I think this is the biggest change that's occurred in financing for small businesses and medium-sized enterprises since Section 708 was introduced to the Corporations Act, which was 35 years ago. And that enabled a private company to be able to raise up to $2 million from 20 investors in a 12-month period. Very good legislation, in fact, legislation that's still being used. But now with the current problems that small businesses and medium-sized enterprises have with raising capital because of the aftermath of the Banking Royal Commission, I think there is a significant opportunity for small businesses and medium-sized enterprises to be able to reorganise their affairs, expand their businesses by raising capital without having to find assets that they can mortgage, enter into personal guarantees, and obviously the monthly principal and interest repayments. So it's a great opportunity for businesses of any age to be able to gear up their businesses for expansion. From an accountant's point of view or a business advisor's point of view, this is a very important step on their journey of diversifying the types of services that they're offering their customers to create an activity which will be welcomed by the vast majority of their team within an accountancy firm, because they'll be undertaking new, interesting and challenging work. And from the partners, owners of the accountancy business point of view, they'll be creating new income streams. So I think there's a win-win-win situation. A win for small business, a win for the accountancy team, and a win for the accountancy firms themselves.
Thanks very much for that, Peter. It was very helpful.
Okay, and I'm glad to see that we've got there, and I'm just going to bring this back to there. So thank you very much. Thank you very much, Kevin. We'll talk to you later on then, eh?
Okay, no problem.
Okay, thank you. Bye-bye.
Okay, see ya. Bye.